I'm Ashton Addison from the Crypto Coin Show, and today on Blockchain Interviews with Francois Schonken, Tokenization Business Lead at Fireblocks. Francois, welcome to the show, and thank you for taking the time.
Hey, Ashton, thank you for having me.
You're very welcome. I would love to, before we start, I would love to just sort of get a refresher for those people who have been in crypto for a while, or they're just starting, and they haven't heard of Fireblocks. You know, I've personally seen the name quite a bit around, but I think you guys have a specific clientele that's sort of very specialized, and a lot of people don't really know the full scope of Fireblocks. I know you guys do a lot of stuff, and then I'd love to dive into the tokenization focus with you and your specialties after.
Absolutely, happy to touch on that. So Fireblocks is a custody and tokenization infrastructure company. We started back in 2018, if I'm not mistaken. We honed and refined MPC-based key custody control. We have a derivation thereof, MPC CNP, that we had open sourced. We have very, very deep technical expertise around the securitization or the securing and management of custody in the backend. Talking to our clientele, well, it's a pretty broad gambit. We very much take a infrastructure perspective. So we have in our 1,800 plus clients, many of the largest exchanges, many large banks, many large FMIs and asset managers. So we really span the gambit from crypto to DeFi to more CeFi. And we pride ourselves on that, and the fact that we have the flexibility to interact on those various dimensions. People much more eloquent than myself could probably make a better case for exactly what the nuances on the crypto side is, but on the custody side is. But in my technical assessment, it's a very strong platform to build tooling upon.
Great, thank you for the intro, Francois. And on the business side and just what we're seeing with the landscape so far in 2024, I think Bitcoin is now making its way into the news with the ETF approvals. More businesses are going to be saying, hey, you know, we want to get involved in cryptocurrency, but also blockchain, and hey, how can we also use it in our business? I think tokenization use cases are going to come from all industries, public, private, every direction. Would love to hear a little bit on what your focus is with relating to that. Then we can dive into those details.
Absolutely. So I heard a wise man use the quote, people say Bitcoin is the tide that lifts all boats. I think his name was Ashton.
Yes, I have said that.
Our expectation is that as engagement in this environment ticks up, we will probably see a correlated uptick in tokenization. Now, I say correlated, I'm not thinking one-on-one. There is a lag because what we find is large institutions have such a large budgeting and planning window that it takes them a long time to direct. It's the old adage around a oil tanker. I mean, it's big, it'll get there, but it takes a while to get turned and go into the direction. But what we do see is we see a lot of renewed energy around corporate debt issuances. There's a lot of energy around unit of account. So when I say unit of account, I mean stable coins and deposit tokens. Interestingly enough, over the last 6 months or so, we have seen a lot of renewed energy in joint ventures between marquee banks wanting to create currencies within local domains and surface those on exchanges so that they can create a set of collateral that folk can easily interact with. And we see this in Europe, South America, and in other places. And then something that, given the higher interest rate environment we're seeing a lot of, is people showing interest in yield-bearing assets. So in low interest environments, people just hold on to their stable coin as a means of getting ready for speculation on other instruments. given that you're in a high interest environment, are you going to keep it there? Or are you going to just put it in the bank and get your 5%? To that end, yield-bearing instruments and even things like money market funds where there's interest in using that as a unit of account or unit of trade, we see a lot of uptick there. The usual entrants are in there as well, bank guarantees, supply chain finance, but the energy around them tends to be the same. These are the ones I mentioned were the ones that kind of pick up.
Mm-hmm. That's a good insight. And I know that there are many banks, central banks, private banks, governments, probably all working on some kind of unit of account based on the blockchain, CBDC of sorts. And you're right about that tanker analogy that, yeah, this is something big. You know, if it's going to affect the whole country or the whole banking system, it's not something that they can just do in a week. You know, it sort of has to be taking cautious steps towards it and transitions towards it. What are some of the things that you and the team at Fireblocks are doing to help lower those barriers to entry or to lower those barricades to help get them over the finish line?
I'll address that in two aspects. First, I'd like to call out a project that we had the privilege of working on. So for your audience, I'll take a moment and go through what BIS is. So BIS is the Bank of International Settlements. So we're TradFi, absolutely. And they have a division called the Innovation Hub. The Innovation Hub is a spin-off where they engage with new frontiers in tech. Their mandate is to create patterns, not really develop product. So the BIS Innovation Hub, recently, this is in last year, we helped them on a project called Project Mariana. Project Mariana, for a techie like me, very, very interesting. The tagline for the project was deep liquidity. And basically what you had is you had three central banks. They had their own independent private networks, two Hyperledger Bezu, one Quorum. These banks were Banque de France, representing Euro, Swiss National Bank, representing the Swiss franc, and then MAS, representing the Singaporean dollar. We helped implement a CBDC. That CBDC, we bridged onto a public network. Then inside the public network, we used an AMM to do exchanges between the currencies. So obviously, this is not targeting myself or yourself. This is large financial institutions moving billions of dollars around and wanting to do that level of exchange. Now, what was interesting in that was that we were afforded the option of working with Michael Igorov. He is the original author of the Curve protocol. And because you've got Curve, you get to have three currencies instead of just pair currencies with routing, which yields a bit of a bonus. So to your question, where are we focused? We have a division that's focused on that side of the market and engaging with central banks in everything up to the hypothetical research down to implementations of something called uniformity of money. Now, when we think about uniformity of money, in the it's mid-2021 in Europe, they released a paper talking about the notion of uniformity of money, and one of the pieces of data in there was this idea of the money flower, which basically says that you need to think about your unit of accounts in a way where it's interchangeable the same way a dollar is that you would hand from your wallet to me. Now, if you have a plurality of stable coins, which seems inevitable, you need a mechanism whereby you can enact that. We're working with folk in South America and some folk in Europe where we've implemented a CBDC-backed unit of account that does that exchange in a real-time basis or on transaction basis. For folk that have a bit of central banking knowledge, basically we execute in-time exchange settlement accounting. So that's in the hyper-theoretical perspective. Then on the more tools and offering to get companies up and running, we have a set of opinionated reference smart contracts that is the product of the last 2.5 years of our consultation distilled into what makes sense in a highly regulated environment, and we have a set of reference architectures, how you can bring that to bear. So we can now, in a pretty short term, take a customer that is commercially ready from zero tokenization into having their own unit of account, having their own money market fund and their own bond issuance, with what we believe to be a very healthy balance of the on and off chain expression. When we think about tokenization, we've joked we're going to get this tattooed on ourselves, but express on chain only that which adds value on chain. We find that when people are new in this environment, they tend to want to express the full workflow the same that they would in traditional banking systems, and that's not where you garner your benefit out of this environment. Whilst technically possible, it doesn't get you to a positive space. Now, if you focus on the Byzantine fault-tolerant nature, so the lacquer double spending risk you have in these assets, and you focus on the elements that have value not to yourself but to your customer, then your projects, in our experience, tends to take up and tend to run pretty well.
Very interesting. And with some parts that you mentioned there, with the author of the Curve paper and talking about the AMM, sort of makes me look into, from a crypto perspective, DeFi and how it is now. Is there a major difference in how these banks and the digital dollars that you're working to build with them are integrating into a sort of hybrid TradFi banking of DeFi, or is it very similar to what you would experience on Curve for transferring, lending, borrowing, that kind of stuff?
I'd say there's material differences, and the material differences tend to be informed by the operating pattern of the respective entities. So if we, and don't write this in any form of thesis, but if we think about what a bank does, typically, they take deposits, they hold the deposit, and then they make loans on the back of it. And assuming they're regulated, there's a ratio, a reserve ratio, call it 10%, that needs to be held at central. Now, if you reason about that, the incentive for a bank is to interact with capital off their balance sheet, not lock capital into pools. So the likes of an AMM for your average bank isn't very appealing because it's a capital inefficiency. This is why you will find that whenever you do significant FX transactions, you always tend to get a spot price because the spot price is related to what they can achieve and what is happening on their balance sheet at the time. Now, if you take that little bit, the notion of holding large reserves and taking yield on the back of that isn't very appealing to X. There's mechanisms around that and ways you can work with that, but it does get very, very complex, and you blink and then all of a sudden you need a super complicated Oracle set of infrastructure to hopefully make that interlink possible. Now, that's on the FX side. But when you think about the settlement and the settlement efficiency side, on that side, there is enormous excitement from a bank's perspective. Using traditional rails, if you're a bank and you're a premier bank and you do a inter-country settlement, that, if it goes well, takes 3.5 hours. Now, there's a bit of fees associated with it and a fair bit of admin. If you look at the option of having units of account as your sub-ledger, doing these large settlements and then sub-ledgering them out, this now takes the amount of time it takes for your selected blockchain to mine a transaction. I have had the great fortune of sitting in a room with people that run treasury at pretty large banks and just seeing that aha moment when they, for the first time, see a transaction executed. And they realize, and this is one of the pieces of beauty of large at-scale, let's say, attack-resistant public blockchains, you can have a large entity, let's call it the Acme Bank, and the Acme Bank has branches in, I'll go, my jurisdiction will go Australia and Singapore. And then you can do a transfer between those two. They're different legal entities, but the confidence in the expression of the asset on something like Ethereum mainnet is such that you can run the subledger and then pipe that back into your own accounting and then do a larger netting off. This is just one example where some of that DeFi power is very, very appealing to traditional markets.
That's incredible. And you mentioned there Ethereum, the mainnet, and we've been talking about private networks, public networks as well. I'm guessing that a lot of these banks, at least with the testing, probably in the production as well, they're using some kind of private networks or private blockchains. Is that based off of Ethereum language? And then if they're moving into public networks, is that also on Ethereum, or is it layer 2s on Ethereum or other blockchains?
Actually, I'm going to respond from a energy and market participation perspective, because obviously there's exceptions. But the bulk of what we see is that customers are gravitating towards EVM. And it doesn't have to be Ethereum, but just EVM. And if it's EVM 1.0, you're probably okay. It's more than stable enough. We had an example where mid of last year, we worked with Tel Aviv Stock Exchange. Now, Tel Aviv Stock Exchange is partnered with the Ministry of Finance in Israel, and contained within the Ministry of Finance is the account general, and the account general is responsible for all debt issuances. So that's government bonds. Now, Tel Aviv Stock Exchange has a very, very interesting relationship with the account general, where bond issuances are enacted using a maker-checker process. So what I mean by that is that the account general will put forth a proposal for a bond. Tel Aviv Stock Exchange will approve that proposal, and then upon receipt of approval, the Auditor General will issue the bond out into market. So Project Eden was about running that process on a blockchain and then having 12 primary dealers. So these are wholesale banks, 5 domestic, 7 international. Think Goldman, really, really large banks participated in this. And they would run their bids, because you would do this authoring, a collaborative authoring cycle. We would pipe it out to a Bloomberg test asset. We would do auctioning on Bloomberg, then pipe the results back, and then we'd execute on the atomic settlement. Now, to your question, what they did in that instance is they started out with a VMware EVM engine. Just under a week prior to the live date, VMware announced that they would deprecate the engine on the back of their acquisition. And we converted the entire solution from EVM to Hyperledger Besu in sub 48 hours, because it's really a deployment action. It's not a redevelopment. We use the same assets. Now, to that end, their vision was that they could start out with private and then go public. And if they've got assets that could go public, assets that are EVM compatible, that makes life a lot easier. Now, that being said, over the last, I want to say 18 months, I've seen a shift in our larger, let's call it FMI, asset management banking customers, where you would almost have people in the R3, very, very constricted, has to be private. I'll concede maybe Hyperledger Besu EVM camp, all the way over to now they realize, well, public infrastructure is where the power is at, and the benefit they're hoping to glean will be capitalizing on secondary markets when they come into play. So I also feel that oil tanker is slowly turning towards understanding these public ledgers have value. Now, the moment you go there, the entire question of PII, so personally identifiable information, becomes central to your challenges. But I mean, that's just a technical challenge. You take it on the chin and you run with it.
Yeah, no, great insights, Francois. And I've heard many enterprises before working on R3 or Hyperledger, but it's great to hear that they're sort of EVM focused. And from what I'm seeing on the crypto side, the amount of large players that have raised hundreds of millions, multiple hundreds of millions, these layer 2s that are coming out, it sounds like EVM is here to stay, and they're making it faster and cheaper than ever on the public network side. So I'm looking forward to seeing where they go and what networks they choose. Now, you mentioned at the end there about the PII. I'm guessing that it's important for these institutions you're working with, especially banks, to have some kind of identity attached to it, whether it's on the blockchain or attached to that. I know that Fireblocks as well, they also recently got a former top regulator that's helping with the identity side of it. Maybe you can talk a little bit about how that fits into the scene with these banks or with all of the companies that you're working on tokenization with.
Absolutely. And it's a near uniform consideration. So I'll use a very simple example. Let's assume in your average common law jurisdiction that you have a debt issuance. If the parcel size is above a certain size, let's call it $100,000, the typical structure in most common law jurisdictions is that you need some mechanism of having the investor be a qualified investor. Now, it's not a very high bar, but it just means that the investor has to sign an attestation. I understand this is a speculative instrument. I understand I'm incurring some type of risk. This is not akin to a bank deposit where I know that a federal entity would cover me if the bank goes under. And then there's usually a small component of just means validation. But that's contingent upon the jurisdiction. Now, that is just commonplace and has been commonplace for decades in these types of issuances. When you go to on-chain, you now have a problem. You have no privacy in terms of what's expressed on-chain. Now, what you could do is you could just say, I've done all of this off-chain and I take Ashton's address, and we say Ashton's address is contained in the set of proofs. And that's pretty good, but it only holds true for binary evaluations. Things like, is Ashton in this list or not? Once we start extending that to, let's call it multivariate considerations, is Ashton in this jurisdiction? Is there any of these claims? And it's just once it becomes a little bit more of a constellation of consideration, that strategy tends to fall over a little bit. Now, what you'd like to do is you would like to express the same type of data points that banks and asset managers and FMIs traditionally hold onto about their customers. You would like to express that on-chain, but that which is expressed on-chain is there forever. I mean, that's the beauty and the scary thing about blockchains. Now, if you think about something like the GDPR regulation out of Europe, and we've got similar regulations all over the world, a large component of that is the requirement that I have the option of bowing out of my information being used. That's a very hard proposition in this context. And this is where the idea of privacy preserving digital identity comes into play. And simply put, what you do is you build a set of proofs off-chain, and then you lodge the proof, and then you can use an on-chain mechanism to confirm that that proof holds true. So that proof could be, are we confident that Francois is older than 21 years? So Francois is allowed to buy beer, or whatever our consideration is there. Now, our approach to this is that research and that environment in terms of executing it at a scalable manner, and that's important because just expressing a proof on-chain, you can do it today, but it tends to be very, very costly. So we are investing a lot of energy in terms of building things that are market and scale ready. We have, however, in a set of opinionated reference contracts, brought to bear a pattern which we call access registry, and it's a generalized pattern around allowing for the holding and participation on assets. And our first examples, an allow list, which is a whitelist, and a deny list, which is a blacklist, is already in play. But the architecture is built such that that is consumed as a service on chain. And then when your privacy preserving DID comes into effect, you can just swap that service out. And this seems like a minor consideration, but once you have a plurality, let's call it 24 assets, you don't want to be managing access on a per asset basis. And that's something that we do find people sometimes get tripped up on.
Mm-hmm. Great insights. And yeah, I'm glad that there is a focus on privacy as well, especially when you have these public blockchains. And for people that are using, just the mainnet Ethereum, it's like once you have an address, then you're looking into your account. And if there's no sort of standard for giving your identity to prove something, and if the security around that is not secure, then you don't really know what you're getting into. I feel like there needs to be some more strength to the security levels. So I'm glad that Fireblocks is helping with that. Now, Francois, we don't have a lot of time left, but I want to look forward towards the future. 2024, I'm optimistic, and 5 and 6, and what you and your team, the vision that you have for the future of tokenization, its impact on the financial services industry, and how you see Fireblocks playing a continued role in that.
So I think summing that up in a single sentence, I would say that we are very excited about making available pieces of infrastructure and building blocks, and then seeing how our customers get to delight their customers. Now, you'd pick up that's just us borrowing a page out of the AWS strategy, but obviously that's where you would borrow it. It's the right place. Now, if you think in terms of asset classes, we are very encouraged in terms of the width of assets that are now being explored and expressed on chain. We are really, really excited by the development of secondary markets. Now, when we think about this in-house, and I'm borrowing this phrase, for the longest time, people would argue focus on minimum viable product. To us, this is a minimum viable ecosystem play. So we do not go in and just sell you on the idea of using our piece of infrastructure. Now you've got the wallet or you've got the token. A dedicated division within Fireblocks is the Fireblocks network. It provides a set of technical tooling that makes it possible to transfer and have confidence of your counterparty. So it mitigates almost all of your counterparty risk in terms of understanding who your counterparty is. But built on top of that, from an organizational perspective, we lean into working with our customers and finding counterparties that could help them execute on their larger vision. Because if you're going to tokenize, you're probably going to tokenize because you want access to a new market, or you want a greater level of retention, just leaning into that cheaper, better, faster commonalities. And I'd say the thing that excites us most is the energy we're seeing around the network and around businesses having the option of engaging and the creative ways in which they engage to bring new financial offerings to market.
Very exciting. Thank you so much, Francois. And I completely agree on the expansion of tokenization. I see that you have a big picture of it. What I think 2024 may be part of the year of more real-world assets in new industries becoming tokenized as well, and more markets to trade them with lower friction through the blockchain technology. So it's a very exciting time. I really thank you so much for all the insights into this part of the industry that I'm not as familiar with. Looks like Fireblocks is doing an incredible job. Keep up the great work, and I would love to follow up in the near future.
Absolutely, and Ashton, thanks for having me. Really appreciate it.